When you see AAA or BB or BBB, it's not just alphabet soup. It's coded opinion on how safely money will return.
Welcome to Decoding Credit Ratings, where we break down how credit rating works, why they matter, and what they say about a company's financial strength.
Today we will decode what a credit rating really means, how those three letters get assigned. Those three letters or two letters aren't random. They are built on numbers, analysis and judgment. A complete assessment of how likely a borrower is to repay on time with full. A credit rating is an independent opinion expressed in form of symbols or grid, indicating the relative degree of risk associated with timely repayment of financial obligations. It reflects an entity's capacity and willingness to honor its commitment as per the terms of contract. Ratings are not recommendation to buy, sell or hold any security. They simply express credit quality. The main purpose of credit rating is to bridge information gap between borrowers and lenders. In any financial market, there are two questions. Can this entity repay me on time and in full? And second question, how sure am I of that? A rating provides a structured answer to both. It helps banks price loans better, investors select safer instruments, and companies gain access to capital on fairer terms. In short, ratings build trust and the trust reduces cost. A credit rating is arrived through a well-defined process. We'll start with the companies approaching a rating agency and submitting detailed information, financial statement, projections, business plan and management detail. The agency's analytical team that evaluates four core areas. First, the business risk, financial risk, management risk and fourth, the project risk. Each aspect is analyzed through quantitative ratios, qualitative factors such as industry outlook, market position, cash flows, adequacy and governance. The findings are discussed by a rating committee, an independent group within the agency, which assign the final rating symbol after collective deliberation. Every rating, as we discussed, is built on four main pillars. First, business risk, financial risk, management quality and project risk. Combine the numbers with judgment. That's how a rating is born. Ratings are expressed through symbols which are standardized across all rating agencies. For long-term instrument, the scale usually runs from AAA being the highest and D being the lowest rating. AAA signifies the highest degree of safety with minimal credit risk. As you move down to AA, then A category, then BBB category and then BB category, the level of risk gradually increases. Any rating of BBB minus and above is considered investment grade. Rating below that are speculative grade and at the bottom a D symbol indicates default. Short-term ratings uses different notations for the facilities which are short-term in nature, such as A1 plus, A1, A2, A3 and so on till A5. Understanding these symbols help decode the language of risk. It is important to remember what a rating is and what it is not. A rating is not a certificate of good management or a guarantee of profit. It does not measure market value or liquidity. It is only an assessment of credit rates, the likelihood of timely payment of interest and principal in full. A high rating indicates strong capacity to repay, while a low rating indicates vulnerability under adverse conditions. Rating is valid as of the date of issue and can change if circumstances changes. That is why surveillance, the periodic review is also very critical. We have decoded what a credit rating is and how it is assigned. In our next discussion, we will explore who is those rating agencies are, how they function internally, and what safeguards ensure their independence and credibility. Stay tuned as we continue decoding credit rating from ratings to real talk.